We're going to get started again with our final two speakers before we go into our lunch and then our panel session. The next guest speaker we have is from Ameren. Please welcome Brad Kloeppel, who is the Director of Gas Transmission Business Development.
Someone wants to ask questions already? Is that what I heard? All right, so being the second day of the conference, obviously a lot of my presentation is going to be a little bit of repeat. So I'm going to try to go through the first few slides fairly quickly. I think the last two slides of my presentation deal primarily with the interaction between the two industries, and I think that's where maybe a lot of the questions will come from. So we'll try to get going and get through this. First slide is a commercial for Ameren, for those of you that aren't familiar with this. Typically known as the St. Louis Electric Utility Company, founded in 1902. In the development of the World's Fair. Obviously, a lot of, in the industry, a lot of merger acquisitions. So we eventually formed the name Ameren in 1997, and we have two core operating companies, Ameren, Missouri, which is former Union Electric, and Ameren, Illinois. Between the two, we have about 2.4 million electric customers and about 1 million gas customers. We used to have another operating subsidiary, which was our unregulated Illinois generating fleet that we recently sold to Dynegy. And we sold the coal units to Dynegy, we sold the gas units to Rockland. And as part of that, a little bit of my background is that for years we managed all of this as a fuels company. We've recently broke that up into two models for both operating companies. But we bought all the gas, oil, coal, diesel fuel, everything through the fuels company. So our group had a lot of things, saw a broad spectrum of parts of the energy business. Oh, I'm sorry, and they would kill me if I forgot to mention the Ameren Transmission Company, which is our new darling subsidiary, which gets all of our CapEx dollars for the next 5 years. So we got about $2.2 million of investment planned at the formula rates and FERC returns at 12.38%. So people are pretty jazzed about getting all those projects. All right, this is a repeat from some of the other presentations. Again, we don't really need to go over this a whole lot. Probably just want to point out the Marcellus gas. It's really, you can't overstate the change that it's had to the natural gas industry. And we got another slide later that talks about gas flows, and I think Brian talked about this yesterday. But the traditional flows, the Gulf of Mexico to the northeast, and then you had the Mid-Continent area to Chicago, Mid-Continent area to the northeast. Those were the big gas flows for years and years. So putting this big resource base right near the population base has a huge effect on the natural gas grid. Also want to point out the potential gas committee estimate. We use the technically recoverable estimate internally at Ameren, and the reason we do that is that 4 or 5 years ago, what was proved improbable but was considered uneconomic or technically unrecoverable has now become proved improbable. So we're thinking in the terms of this trend keeps going. At some point, all this gas is economic. At some point, the technology is going to become available to get to it like it has in the last 5 years. So that gives us about 150 years of demand at the current levels. And just another interesting point about the Marcellus is that Bentech is estimating by 2017, the Marcellus alone will be providing 25% of the U.S. gas supply. And that went from essentially probably 1% to now 25% in about 5 or 6 years. Another good slide showing the production growth and the contribution of shale gas. You can see by 2015, we're expecting it to be 50% of total supply. And again, as all those years that we saw the conventional kept dwindling, people were getting concerned. Now you see the shale gas taking over. Interesting of note, again, when I started in 2002 trading natural gas, every day you got your market reports, and there was always a weekly summary of the rig counts, and you were always trying to figure out where the rig counts were being directed, which basins they were going to. That would be your development costs. Well, the rig counts over this period of time from 2009 to 2013 have gone from 1,600 rigs dedicated to natural gas to 370 rigs working on natural gas. So that kind of tells you the activity. Obviously, the oil price is pulling some of those away. And some of the picture that it doesn't tell you is that a lot of these rigs are dedicated oil rigs, but they're pulling up a lot of associated natural gas in the Marcellus, in the Eagle Ford, and the Bakken. So rig counts aren't what they used to be is kind of the thing. It's something that we don't even look at anymore, quite frankly, other than to know which basins that people are pulling rig counts completely out of, because then that tells you that they're at that price point, they're kind of giving up on that basin for the time being. So this, I don't know if anybody has showed a slide like this. I was going to breeze through this one, but I don't know if people have seen this very well, and maybe people that don't understand it as well. Aubrey McLennan gave a presentation like 4 or 5 years ago that I went to where he talked about, we're going down to the kitchen now. And the way he explained it is that we used to go into the dining room, which was the room adjacent to the kitchen. So they used to drill vertically for gas down in an area where this gas would seep up from the shale, and then it would get trapped by some, impermeable layer. Sometimes that impermeable layer was actually another shale layer. And that's where they would accumulate the gas and pull the gas out. As long as there was enough permeability to get the gas to percolate up from the shale to get to that next layer, that was an effective rig. Well, now they've bypassed that. Now they go right down into the kitchen. So they're going right down to the shale gas, penetrating it, and then going horizontal. They're doing their fracking to make that impermeable rock permeable now, so that gas is released and flows from the shale through the wellbore. And this has been developed over the years, but Mitchell Energy really went after this in the Barnett Shale in Dallas in the mid-early 2000s. And for years, they would be drilling through, even water wells. They would drill through these shallow shale things, and they would get a puff of gas. And one of their engineers was mentioning that he wanted to do more work in that area, and people said, oh, don't. We've been chasing those for years. The rock is too impermeable. It's a puff of gas. It comes out hard, but then you can't get to it. So that's really where they combine the two technologies. They used to frack vertical wells, and they used to do horizontal wells. Well, so Mitchell, it doesn't seem all that ingenious now, looking back at it, but at the time, to make the technology work, to actually drill, to go a mile deep into the ground and then go a mile horizontal and then be able to frack that well, basically that's unlocked everything, as you'll see in the next few slides and in the production slide, the prices slide. Again, the game changer that this has been huge. So someone from the EPA was here to kick off this meeting, and you notice they never mentioned anything about the fracking. They're talking about carbon the whole time, never mentioned it. Don't think you can read that, and unfortunately I've got the notes presentation. I can't read it on mine. But if you go to the natural gas tab on EPA's website, and I'm going to try because I can't do it at all. If anybody can read that, basically it says natural gas plays a huge role in our energy future. So this isn't the EPA coming out saying, oh, we're really worried about the fracking industry. We're really worried about what they're putting in the ground they're coming out basically in support of natural gas. This has been on their website for about 3 years now. And I think most people know that in 2010 they came out with a study they were going to do for 2 years. It was going to end in December 2012. Guess what? December 2012 came, and they said, we really don't have anything. We're going to extend this another 2 years, and we're going to release the report in 2014. So you see how the natural gas production has grown in those 2 years, and my intuition is that if they're taking this long to study it and they're allowing it to grow the way that it's growing, that they're really not finding much in this report. However, we do expect something. And some of the states have already jumped out ahead of the EPA and done things. And our state, Illinois, has done something similar. They came out with the Hydraulic Fracturing Act last year, and it must be a pretty decent law because it was basically widely criticized by both parties, by both the environmental groups and the gas production and oil production groups. So I think it's looking to strike a balance between what's considered responsible drilling and putting a little bit of burden on the production companies to report and do some of the things that they really get a free pass on today due to the Halliburton clause that people call it in the Clean Water Drinking Act. And again, this is a current active shale well being drilled. However, when this all goes away, this lasts for about 3 months, and when it all goes away, all you're left with is a Christmas tree above the ground and a water holding tank. And that's about it. I should put one of those pictures on there as well because But you know, we're not trying to hide the fact that it's kind of like making sausage at times. It looks a little bit ugly when it first starts. So the impact of natural gas prices. Again, some of this information is repetitive. The one thing I want to point out is that what we've seen when we talk about the rig counts and what we do follow and watch is that where they're pulling rigs out of. And they've pulled rigs out of a lot of places that they showed a lot of promise, have a lot of resource base, that are the break-even costs of around $5.50 to $6. So that's kind of telling you that, you know, we're sitting here at this long range bound between $4 and $6. And Ameren's point of view is similar to the NYMEX actually currently, that we can't get much above $6 because there's almost a ceiling at $6 where a bunch of more gas that they're not even drilling today becomes economic. And another little tidbit about the drilling industry is that in 2008, 2009, when it was rigs and crews were being difficult to keep or to get under contract, a lot of companies had to go out and make long-term commitments to be able to get their rigs and their people. Well, the gas price, of course, responded and went down, and they would like to slow things down, but they have all these rigs and people under contract, so they keep going and keep drilling more wells. And Bentech is just last week put out a paper that said that there are 2,063 wells that have been drilled but haven't been completed for production. So there's 2,000 wells just sitting out there that they've already done the fixed cost, they drilled them, and they're just waiting for either the price or the demand to respond to go back and complete those wells and get them on production. And they also expect that inventory overhang to last until 2018. So again, if we're thinking that there's going to be any short-term spikes in gas, I mean, in the Henry Hub futures, NYMEX, you're not going to see that. You're going to continue to see regional price spikes. And again, what I'll get into at the end of my presentation, that's more of an infrastructure thing, as other people have alluded to. And I totally agree that, again, as we've had all this price volatility this past winter, the Henry Hub never changed. Hardly changed, I should say. Again, not last slide, but this was a slide I was alluding to earlier that shows our pipeline infrastructure grid and the magnitude that basically all this infrastructure was built to move the gas to the Marcellus, which now is producing its own. And again, in that same Bentech report, they said that in 2016, Marcellus will actually be producing more than that region can consume. And that's going to be in the summer of 2016. So pipeline infrastructure is going to have to be built to get it out away from there now, because they can no longer, even if they shut down all the other contracts, which is really not possible because these LDCs have long-term contracts in place, but even if they could, they're going to have an excess supply in that location. And a little sub-bullet there that we mentioned in this presentation that says that we saw the extreme, price swings and volatile spot prices. So, and we're mentioning January 24th in this, where you had the New England price was about $100 MMBTU, and the Henry Hub was at $6 that day. And not only was the Henry Hub at $6 that day, gas exiting the Marcellus was at $6 that day. So you have an area, you're only about 100 miles apart, and you have a price differential of over $90. I think if someone had pipeline capacity, they would have been moving it that day. John's not here to get that dig. I did not know that animation was on there. Here we go. All right, so we've got the abundant supply. Now, how is demand going to keep up? And quite frankly, demand is having a hard time keeping up. But there are, around the corner, there's a lot of things. Obviously, power generation is going to be a big one. We're expecting big increases in power generation. But I hate to break it, but all this gas that we've found and is out there now is not reserved for power gen alone. There's a lot of industrial projects coming back to the United States. Our low energy price is basically now overcoming that barrier of our high labor cost that has hurt us over the last few years. So we're seeing a lot of inquiries for fertilizer plants, petrochemicals, plastics that are looking to relocate back to the United States based on our cheap natural gas price. The transportation sector, it is growing. I mean, I know people keep asking, is it ever going to happen? Is it ever going to happen? Well, it is happening. We're getting inquiries weekly from small companies and from people that are looking to put speculative CNG refueling stations throughout the St. Louis metro area. But we're getting a lot of fleets, a lot of the FedEx, the UPS, for instance, in St. Louis, one of the big dairy companies is converting their whole fleet to CNG. So for CNG, the difference between CNG and LNG, by the way, CNG is going to be more for your small fleets, like your UPS trucks that can drive around a metro area all day and then park at night and then fill on a slow basis overnight. They don't have the capacity. The tanks don't hold as much. For the liquefied natural gas stations, that's going to be for the over-the-highway diesel trucks and the conversions that are going on there. And that is also happening as well, really despite many incentives currently by the federal government, which we also think may change in the future. And Obama's mentioned it in a State of the Union speech the last 2 years that we need to do more to try to get people using more domestically produced natural gas for transportation and reduce our dependency on foreign oil. In our area, what we've seen is that Clean Energy Fuels, which is the T. Boone Pickens company, has been partnering with Pilot and Flying J truck stops, and they're putting in a network of stations. They're trying to get them about every 350 miles apart, which is the typical range for actually for the diesel equivalent as well. So, and they're doing a lot of unique things where companies can offset the initial higher production cost of buying a LNG diesel. They can enter into a contract with Clean Energy or with another provider like Shale is also doing the similar thing where you can buy all your fuel at a diesel minus product. So say diesel minus 50 cents, and that 50-cent savings then more than offsets the cost of the upfit to LNG. So there's been a few creative things going on out there, but it is moving. You may not be hearing a lot about it now because the orders are just, you're not seeing them on the highways yet, but it's getting very close. Now, there's a little bit of a repetitive slide from Brian's yesterday. I think we're showing it just a little bit different, but it's the same message. We're saying that, again, 63% of all new generation capacity through 2040 is likely going to be natural gas. Something that we see in our area, and it's not always picked up on yet, is that until we have some type of battery storage or more pump storage, you're going to see a lot more of the peaking gas-fired generation that will be required for capacity. For instance, we're on the Missouri side now, we're just a purely regulated electric generating utility. We can put so much renewables out there, but eventually we have to back that up with gas capacity. Our commission's going to require us to have that firm capacity. So there's some additional demand that will be from natural gas that will come from that. Our coal guys usually don't like this picture, which is why we have it on there. But yeah, this is one of our old coal plants that we eventually tore down, but this was a picture that was taken before then. But again, the impacts of the Midwest generation, obviously we're a lot of heavy coal companies, Ameren, AEP specifically, are going to see probably the biggest challenges. You know, we've enjoyed some of the lowest electric retail rates for years now, well below the national average, and that was because we were predominantly coal. So, you know, other people have diversified a little bit more, spent more money. And that was probably reflected in rates, and it's probably our time that we're going to have to catch up with that. So this is where I started to get into the maybe potentially controversial issues. What we see has to change is, again, pipeline infrastructure changes are going to be required. You know, the pipeline system was designed, well, as I said yesterday, it was built on the backs of the LDCs, but it was also designed for the LDCs. It was designed so they can predict their loads in 1 or 2 day basis with relative accuracy. They can set up the system, they can get their compressor stations all in line, and they can feed that flow. Well, you know, it wasn't designed for a gas turbine that's going to use, you know, all of its gas over a 6-hour period. So they've got a lot of changes, and, you know, they've made a lot of changes to their system over the last few years, and, you know, a lot of that was actually done still yet on probably the rates that were being paid by the LDC customers. But the pipelines were, you know, wanting to, of course, grab this new part of the business. So again, we think that, you know, the reliability in the pipelines is going to require generators to hold more firm gas transportation. And it all goes down to state by state. You know, on the Missouri side, we always had firm transportation for the key units that we knew we needed on a peak day, or units that didn't have oil backup. On the Ameren, Illinois side, we were completely unregulated, but we tried to play the game too. You know, just like everyone else, we wanted to lower our fixed costs. We were going to get out there and try to get that interruptible gas transportation whenever we needed it. but we didn't want to pay for it year-round. So again, I think that's just going to be a tough environment in the future. As more people depend on natural gas, it's going to become more and more unavailable, and don't want people to be surprised when that happens in the future. So this is the slide, coordination between electric and gas utilities, and the caption I used here was people laying pipe, because again, I think that's going to be one of the main solutions to the problem that we're seeing. Has anybody, just by show of hands, been involved in the NASB process where they're looking at changing the gas days, electric days? One. Oh, horrible, horrible process. Very important to the industry, but it was a horrible process. I think we wasted like 6 days batting around all the issues, and they were trying to satisfy every single quadrant of the gas industry, the gas utilities, the power providers, the producers, and the interstate pipelines. And at the end of the day, we came to zero consensus. So after all these proposals were out there, we basically went back to FERC and said we could not reach a consensus for the most part. But the big thing that FERC is putting out there, and that this started with the gas-electric coordination little roundtables that they had over the course of a few years, is that, and it's a problem for us, it's the winter morning peaks that you're seeing. And in defense of people as they were developing the gas-fired generation, as we were developing our own fleet and got up to 4,000 megawatts before we sold some of that, we were always told by our planners that, don't worry about winter. We do not need these units in the wintertime at all. So that's kind of the way we developed them. We weren't going to hold firm transportation over the winter. We even hooked some of these up to pipes that we knew didn't have any winter capacity available. So guess what? 4 years later, now they are really pissed that come a cold winter day, we can't run. And it's one of those things where I wish we had a tape recording of the conversations we had earlier, but that's become probably the biggest issue. So in moving the gas day up from 9 a.m. to 4 a.m., what that's really doing is that's giving the whole country the opportunity to get both winter peaks in the same gas day. And for you that not that familiar with the gas industry, 5 p.m., since we were 9 a.m. to 9 a.m., well, the 5 p.m. was the deadline for all nominations. So once 5 p.m. came and went, you had no changes that you could make at all. So we had like quick-fired units, some FT8s, decent heat rate units that normally would have gas available or would be perfect for that morning peak, that morning ramp up in the wintertime. And they're just unavailable because unless we knew that they were going to be committed or racked on or even get their day-ahead award, we couldn't provide that gas for them. So getting the gas day moved up to 4 a.m. is going to make a big difference. It should allow a lot more flexibility on the power side and the ramp up during the morning peaks, if there's gas available for those peakers, obviously. And then the other big change is they're moving the nomination for timely from 11:30 to 1 p.m. And this is, again, these are things that FERC is proposing. I personally think they're probably going to go through, even despite NASB not being able to recommend them. But the only reason the gas industry is willing to do this is if the power industry also moves up their day-ahead award process. So there's some overlap between the two. And that's kind of where, we'll see how that pans out. What we proposed, and we're in the Midwest Independent System Operator, they have taken somewhat of a neutral stance, but we're proposing that they at least move that up to noon, so from 4 to noon. And realizing that's going to compress a lot of planning schedules, but at least you get 1 hour to secure your gas and get it nominated on your firm schedule so that you know that you've got 100% rights to your firm capacity. The next one was the intraday cycles that they've been discussing and the no bump rule. And what the bump rule, no bump rule means, it's kind of confusing to me even after being in it all these years, but it essentially means that at some point in your nomination cycle through your gas day, if you're a firm capacity holder, say you don't nominate that morning on all of your firm capacity, well then the pipeline sees that you haven't nommed that, so they see that it is being available. So they allow that then to become open to the interruptible transportation market. So you have so many cycles, though, where you can go back and still nominate your 100% rights and bump interruptible off of your firm transport contract. And that's been a big rub. Again, the power industry wants to see that to where, they would love to see it at the timely cycle, that there's no bumping after the timely cycle, so that if they jumped in there in the next nomination cycle and there was capacity available and they signed up for it and got their gas nominated, that would be theirs for good, that they couldn't be bumped off. But then from a firm capacity holder right, you think, well, I'm paying that fixed reservation charge. Why should I ever get to a point where I can't bump somebody off of my firm transportation? So that's really where the rub is, and it goes back and forth. And obviously, to optimize the pipeline, you want something in between there, and you want to be able to utilize interruptible. It's the best use of the resource. That's what FERC wants to do. That's what we'd all like to see. But it's how you go about it. It's going to mean a lot. And, you know, who pays for the changes? Even the pipeline industry is pushed back with, like, you know, we can change our gas day from 9 a.m. to 4 a.m. We can change our timely nomination cycles, but now we have to go through and reprogram all of our IT infrastructure. And who's going to pay for that? Well, the answer comes down to, and kind of what this NASB process and all this has opened up, is that the gas utilities have realized that they've been subsidizing the electric utilities for quite some time in this industry. Because, again, most of these pipelines are saying, well, the electric customers don't have firm transportation. So how are we going to recoup these costs when we go through and reprogram everything? The only way we can recoup it is to get it from our firm transportation holders, which are the gas utilities. So the gas utilities are pushing back, saying, why are we paying for all this stuff for you guys? So that was the last straw at NASB when they pulled back. One reason why we couldn't reach consensus was a lot of the gas utilities just pushed back and said, you know, we're not going to vote for any changes to the gas day or the nomination cycle because we know that we're going to be the ones paying for it. The other thing that, again, that we talk about is and we talked about this yesterday at the happy hour a little bit, is that how do you recoup these costs? How will this system ever work? And I don't have the answers because I know the electric industry. I've straddled both sides. I've worked for electric and gas, and I know that, you know, our pressure on the ratepayers is going up with all the renewables. So, you know, we know rates are already going up, but how do we make the system reliable and make it accessible to natural gas and still get the necessary infrastructure built? I don't see there's any way around it other than requiring the gas generators to hold firm transportation. And it can be their choice. It doesn't have to be a necessary requirement, but I think that if you're in a capacity market or if you're in a market that requires you to designate your generation as designated network resources, meaning that you're there and you're ready to respond at any time, then you should have firm transportation to back that up. It's still surprising to me. MISO, the one we're in, they have neither a capacity market and they really don't have a designated resource requirement. They're basically just taking your word for it that if you're submitting these bids every day that you can back it up. And we are in an excess capacity market right now, but that will be changing soon. So I think that the rules are going to have to change as more coal plants are retired and there's more reliance on natural gas. It's all coming to a head. And, you know, you've seen it. New England's already seen a little bit of it whenever people called on what they thought was a firm resource, and the response they got back from the generator was, we can't run. We have no fuel. We can't get their gas pipeline. That evil gas pipeline is telling us that we can't get gas from them today. They're not going to give it to us. So lots of changes, and again, I think that will probably spark some discussion, hopefully. So in summary, again, we think that gas prices are going to stay pretty moderate, $4 to $6 range. Major investments in natural gas infrastructure is required. They're estimating about $132 billion worth of gas infrastructure. And then the coordination between the two industries is going to be vital going forward. Moving the start of the gas day is going to be a big help, and I think it's something that most people really can agree upon and move forward in both industries. But then we have to have market signals for natural gas infrastructure development. Again, there is no regional planning process for gas infrastructure development like there is for electric transmission. It is a pure merchant function. If somebody will pay a pipeline enough money to build the pipeline, they'll build it. But then the person obviously paying for that pipeline is going to have to find a way to recoup their cost. That is all I've got. That's my presentation.
Any questions for Brad?
When you anticipate this $132 billion being spent on infrastructure, do you have a time frame for that? And I'd like to follow up with the question.
Yeah, that came from INGA, which is the Interstate Natural Gas Pipeline Association. So, you know, that number may be a little bit high. Obviously, they're talking their own book there a little bit. But that was through 2035.
And did they give you any indication at that time in that window of how many additional gas-fired plants that might affect with that amount of money being spent?
No, but I believe that that number is definitely coming from a study based on how much coal conversion they believe it will be necessary in the future. Yep.
You mentioned for LDCs, it's easy to predict their load for the day. It's typically residential consumers, it's some industry, and it's pretty, it's slow changing in that the pipelines aren't necessarily used to that full load coming on for 6 hours and going off. What are the pipelines doing to really be able to accommodate that rapid on-off or changes that might be coming with gas generators?
Yeah, good question. I think what a lot of the things that they have done is basically ramp up their storage injection levels in the springtime. So they're trying to get the line packed. So they know they have a window when winter's over. They have a window to get their pipeline packed up. And also one thing they've done is they've altered their maintenance schedules. They used to always do their maintenance over the summertime, obviously, because they're trying to provide for the winter peak. And now they've really, and it's been a problem for the pipelines. Their construction and maintenance schedules are compressed to like 2 months in the spring and 2 months in the fall, maybe, and that's maybe even pushing it a little bit. So they do have to take their pipelines out. But in general, what we've seen is that they've added compression to make the system more robust. And they basically operate their pipe in a different way now, more not so much like as tear per their customers, but really just understanding that they're going to have a stress put on their pipeline in July, August. I knew it wouldn't take long for Brian.
No, do you believe that the current secondary capacity market is set up or tailored for what's coming? The increased reliance on gas as a fuel for power generation, and there's built-in transparencies in that market, obviously, especially when you're releasing capacity. But I wonder if the market is ready for folks who need capacity released to them, whether they can find that capacity, whether that market is really where it needs to be, maybe to deal with some of the capacity constraints that were identified yesterday, where LDCs are holding on to capacity that they need to, but that capacity could have been used in a constrained market to bring gas for power generation on peak days.
Yeah, it's a really good question. The capacity release markets have become constrained because over the peaks of 02 and 04 and 06 and that time frame, and even leading up to, I think, 08, what happened was, and you guys may have seen it in the headlines, there was a lot of shipper must have title violations. There was a lot of, I can't think that the technical term FERC uses for it, but I know BP got caught flipping capacity, which basically meant they were skirting the capacity release rules, and they were flipping it between two affiliates back and forth, where it never actually got exposed to the market. So there's a lot of things that went on with the capacity release markets that FERC addressed in the last decade and did make it fairly restrictive, and quite frankly, it just scared a lot of people. A lot of people that used to release a lot of capacity decided, man, this isn't really worth it anymore because the rules are so tight, and they're starting to hit people on it. But, an interesting thing that we talked about, and we talked about in our Ameren work group at the NASB conference, was what if you got rid of the pipelines being able to even offer, and this is just our idea, don't float this out there to anybody, but what if you got rid of the function of the pipelines to even manage interruptible transportation and just said they couldn't even offer interruptible transportation? What that would force into the secondary market for transportation capacity, where the firm holders would open up the marketplace, and if they weren't using the capacity, then the generators or the marketers or whoever, the industrials needed capacity that day, would be able to go to the to the website, the bulletin boards, and see what capacity was posted and available, and make it a little bit more between the two parties, because right now you're essentially working through the pipeline companies. So you have a capacity release market, but at the same time you have the pipelines running their IT programs as well, and they're kind of stumbling over the top of each other at times.
Any other questions?
All right, thanks, guys.